Okay, so our next topic is impairment of assets. Remember, I hope you people would remember that you people have done 4 types of assets which were classified into tangible and intangible. Intangible, we discussed property, plant, and equipment. And in intangible, we had 3 classifications: intangibles with definite life, intangibles with indefinite life, and goodwill. So impairment of intangible with indefinite life, it was treated in the previous topic, property, plant, and equipment. And the impairment of goodwill, it was also discussed there. Now we are going to discuss the impairment of property, plant, and equipment, your tangible assets, and the impairment of an intangible that has a definite life. So these are the areas we'll be discussing. First, let us grasp the idea, what is impairment? What basically is the impairment? Impairment would occur when the asset that is under use, property, plant, and equipment. Remember, 2 types of assets are under discussion: the fixed assets, property, plant, and equipment, and intangible assets with finite useful life. The others we have already discussed: intangible with infinite life and the goodwill. So what is impairment? Impairment occurs when the asset under utilization, or your property, plant, and equipment, or your intangible asset with limited life, its market price has decreased significantly. That's an indication that the amount you are carrying in your books is no longer relevant. Or maybe the asset has, if it's a physical asset like property, plant, and equipment, its physical condition has deteriorated. And this has caused a significant decrease in its price. So this is called impairment, when the price of the asset has fallen significantly, or when the physical condition of the asset has fallen, or it has deteriorated, and that has resulted in decrease in its price. Now, how do we account for impairment? What are the computations involved? Please, gentlemen, ladies, remember, impairment calculation is very different under the US GAAP and under the IFRS. So we're going to do these side by side so you can make a good understanding of it. In the US GAAP, impairment is a 2-step process. It has a 2-step model. In the first step, we do what you call the recoverability test. What is recoverability test? Let us take some imaginary numbers and we will try to make some sense out of it. Let's say we have an asset which has a book value, or call it the carrying value, of $100,000. What is book value or carrying value? It is the original historical cost less accumulated depreciation. So we are carrying an asset in our books at $100,000. This asset will generate some fulus in the future. It will generate some cash in year 1, in year 2, in year 3, and let's say in year 5 will be over. And in the year 5, it will be sold. All the cash flows, all the net cash flows received in year 1, plus 2, plus 3, plus 4, plus 5, if they are just added, let's say it's 80,000. Now this 80,000, gentlemen, this is called the sum of undiscounted future cash flows, including the disposal proceed of the asset. So when you will use this asset in the future, you will receive some net cash flows, including the disposal price, adding all these cash flows, just adding them up, A plus B plus C, without any discounting. This is called the sum of undiscounted future cash flows. Okay, ji. Now, the sum of the undiscounted future cash flows, whatever we will receive from this asset in the future, if it's added, it's 80,000. Now, this first test tells us that everything is not fine. An asset that we are carrying in our books for $100,000, it will get us only 80,000 in the future, just adding all the cash to be received from this asset. This test, the first step test called the recoverability test, that everything is not fine, the asset is impaired. Asset is impaired. Now, what is the next step? Next step is pretty simple. In the next step, this is step 1, remember, I'm going to write it as S1. In step 2, you will compare 2 things. You will take the book value, which is $100,000, and you compare it with the current fair value at which you can sell off the asset. Let's say if I can sell this asset right now for $72,000. Remember, this is the sum of undiscounted future cash flows. This is different. 100,000 is the book value or the carrying value, and 72,000 is the fair value for which I can sell this asset right now. Now it is evident that an item that I'm carrying in my books for $100,000, basically it has the fair value of 72,000 only. That means that there is an impairment equal to 100,000 minus 72. $28,000 is the impairment of my asset. I must book this as a loss. That's the next slide here. When the first step, the recoverability step, says that the carrying amount is more, undiscounted future cash flows are less, right? If the carrying amount is not recoverable, mean carrying amount is more, recoverable amount is less, impairment loss is recognized, right? And you pass this entry, you debit the impairment loss that goes to the income statement as a loss, and you dump this amount in the accumulated depreciation, because accumulated depreciation is a contra asset account. So you can dump the impairment loss in accumulated depreciation. This will automatically reduce your carrying value or the net book value. So let us do, with the help of this table here, events or changes in circumstances indicate that there's a possible loss. Asset is damaged, or the asset produces certain units, and those units, they do not have any market value. The market has fallen. So which means there is an impairment. So from the first step, you will take the carrying amount, which we assume to be $100,000. The sum of undiscounted future cash flows, it is $80,000, right? The first step says that there is an impairment. In the second step, you will calculate the impairment loss, and this is done by taking your carrying amount, which we have taken to be $100,000, and you will compare it with the fair value, which we assume to be 72. Now, this loss 28,000 is the loss for the period, and this loss would be dumped or included in the accumulated depreciation. Your accumulated depreciation goes up. Like, for example, your asset is showing a original historical cost, a certain amount. So accumulated depreciation balance, when it goes up, your net book value of the asset will fall exactly to $72,000, because this 28 goes to accumulated depreciation. When you deduct this from the cost, the new net book value will be 72, and that should be the new basis. Remember, US GAAP is very, very stringent. US GAAP is stringent. Once you write off this loss 28,000, even if the price of the asset goes up, if the fair value goes up, you cannot reverse the impairment loss. A previously recognized impairment loss must not be reversed. And please, gentlemen, remember, impairment would be noted, or it will be brought into your account when event occurs, not when the balance sheet date arrives, or when you publish your financial statement, when the events occur. This is specifically under US GAAP. Whatever we have studied so far up to this point, it is under the US GAAP. So remember, just like the inventory write down, we cannot reverse under the US GAAP. Similarly, any impairment loss on property, plant, and equipment and an intangible with definite life, loss must not be reversed. This must be kept in mind, an important point. Okay, then what about the example we have? We have a good example here. An asset that has a carrying value, a machine carrying amount after the recognition of annual depreciation is 160. What is carrying value? It is the book value, that is the original historical cost minus the accumulated depreciation. So carrying value is 160. Let's write this down. Step 1 says that the carrying value is $160,000. We must compare it with sum of undiscounted future cash flows, just for short. It says on that date, as a result of low demand for the company's products, management concludes that the carrying amount of the machine may not be recoverable. Management estimates that the undiscounted future cash flows over the remaining useful life will be 150. Now, gentlemen, Ghazi, the first step tells us that the carrying amount is more, undiscounted future cash flows are less. That means there is an impairment. There is an impairment. And what is the exact impairment? The next step is you compare your carrying value with the fair value, only fair value. It says right here, on that date, the machine's estimated fair value was 136. So comparing this 160 with 136 means that your asset has been impaired by $24,000. So this is the charge to your income statement, and that's what you include in your accumulated depreciation. Look at this. This is your historical cost. 160 was your initial net book value. Since this 24,000 impairment loss, this is dumped in the accumulated depreciation. Accumulated depreciation balance will go up to 64. So when you deduct 200,000 and 64 from it, you get 136, which basically is your new carrying value, right? That's how you do it. Let's do a few questions specifically with relation to the US GAAP. Please be with me. Blake Corporation remember, gentlemen, when the question is silent, always assume that you have to follow the US GAAP. Blake Corporation has determined that one of its machines has experienced an impairment in value. However, the company expects to continue to use the asset for another 3 full years because no active market exists for this machine. Selected information on the impaired asset on the date that impairment was determined to exist provided the following data. Original cost, carrying value, this is what we need. The undiscounted future cash flows, that is 15, and the fair value of the machine determined by calculating the present value of the future cash flows. We haven't yet discussed present value. This is totally irrelevant. We are not going to consider this. This is discussed in your IFRS, not in the US GAAP. US GAAP requires the undiscounted future cash flows, not the discounted one. So what is the amount of the impairment? First step, we must compare the carrying amount with the undiscounted future cash flows. Clearly, your carrying value is more than the sum of undiscounted future cash flows. That is the indication. Imran, that is the indication that bhai, there is something wrong. Do the step 2 as well. And in the step 2, what we do, we take the carrying value, which is 20, and then we see what is the fair value. Have we been given the fair value? Okay. Just let a little correction here. Here it says the fair value of the machine determined by calculating the present value. Ignore this point. I just cut this out, but we have been given only this number. This is the fair value. I don't want to discuss present value here because you're doing impairment under the US GAAP. So this is your fair value. How it has been calculated, that is not our concern. We need to take fair value. So your carrying value is 20, and the fair value is 12. That means there is going to be an impairment of $8,000. So that makes D to be the correct option. 8,000 will be your impairment loss for the current period. And the new basis as required by the next question. Same question. After the recognition of impairment loss, Blake's carrying amount of the impaired asset would be, now the previous carrying amount is irrelevant. The new basis would be 12,000. This would serve as a new carrying value because after 20 less 8, 12,000 becomes the new carrying value, and that makes B to be the correct option. Right? So when the first step says there is an indication that impairment has happened because carrying value is more than the undiscounted future cash flows, then you go and compare the carrying value with the fair value. And in this case, it was 20 versus 12. 8,000 is the impairment loss, and this new basis, new fair value will become the new carrying value of the book value. So that makes B to be the correct option. Okay, then what we have here. Next question says, to determine whether to recognize the impairment of a depreciable asset, a company must compare. Remember, the question is silent. The first statement is silent, so it must be the US GAAP. So what we do, we compare the carrying amount of the asset and the present value. Present value, I don't like this word here because we haven't discussed IFRS, so this is wrong. We haven't discussed. We just simply take the carrying value and the undiscounted future cash flow. So that's not right. Then original cost and the fair value, we do take fair value, but not the original cost. Incorrect. Carrying value of the asset and the undiscounted future cash flows expected to be generated by the asset. Exactly. That's the right answer. Carrying amount with the undiscounted future cash flow. That's the right option. And the original cost, no. So that makes C to be the correct option. Next, testing of possible impairment of long-lived assets. Zahid, this is specifically for you. Testing for possible impairment of long-lived asset or group of assets that an entity expects to hold and use is required when at each interim and annual balance sheet? No, we have just read that. Not on annual balance sheet only or periodically. It must be done whenever, Zahid, whenever events or changes in circumstances indicate that its carrying amount may not be recoverable. That is specifically for the US GAAP, whereas IFRS is concerned, IFRS will ask you to do it at least annually. So that makes D to be our right option as per the text we have just discussed. Okay, then what do we have next? Yes. A company has a long-lived asset with a carrying value of $120,000. Okay, that's the starting point. Step one, carrying value is $120,000. Expected future cash flows 130. That is what you call the undiscounted future cash flows. That is 130. See, Zahid, do nothing. Your undiscounted future cash flows are more. Carrying value is less. So do nothing. There is no impairment. So present value, blah, blah, blah. We are not interested in present value. I find this word offensive for impairment under the US GAAP. What amount of impairment should be reported? Nothing. Zero. Absolutely right. So there will be no impairment because the asset has not impaired. Carrying value is less than the undiscounted future cash value, so cash flow. So you don't have to do anything at all. Then this one. Last year, a firm reduced the carrying amount of its long-lived asset in operations from 120 to 100. Last year, you wrote down 20,000 from this asset. So the existing carrying value is $100,000 in connection with the annual impairment review. Even it might be done under the IFRS, but here it's clearly US GAAP. During the current year, the firm determined that the fair value of the same asset has gone up to 130. It has gone up to 130. What amount should the firm record as restoration of previously recognized impairment loss in the current year's financial statement? Under the US GAAP, a previously written off loss, impairment loss, cannot be subsequently recovered or cannot be reversed. So we cannot reverse. Even this asset has gone up to 130. The fair value is up by 30,000. We cannot take this as a gain, or we can't reverse this loss. So this is not possible. So that makes A to be the correct option. Okay, now moving on and see how do we do the impairment under the IFRS. All right, so what do we do under the IFRS? IFRS has quite a distinctly different approach. First of all, IFRS says that entity must assess impairment each reporting date. This is in quite contrast to what we've just done under the US GAAP. So at each reporting date, whether an indication of impairment exists or not. In the US GAAP, it has a two-step test or two-step process, but in the IFRS, it's just a one-step impairment test. Given such an indication, when it appears that the asset has impaired, there is an indication, IFRS requires just one-step impairment test. Okay, now what we do, please follow what I'm going to write now. We will take our carrying value or the book value at one end, and we will compare it with the recoverable amount. Mind the word recoverable amount. Let's say if the carrying value is $100,000 and the recoverable amount, I will let you know how do we calculate the recoverable amount, and the recoverable amount is let's say 80. Carrying value or the book value is 100,000. The recoverable amount is just 80. That is a clear indication that there is an impairment of $20,000 because book value is more. The recoverable amount is 80. Now, how do we determine this recoverable amount? Recoverable amount is ascertained by comparing two numbers. One is value in use, and second is the fair value minus cost to sell. Whichever of these two numbers, whichever of these is higher, please be very focused. We compare our carrying value or book value with the recoverable amount. What is the recoverable amount? Recoverable amount is higher of these two, value in use and fair value minus cost to sell. Let's take the same numbers. Fair value was considered to be 72,000. That's what the asset can be sold for. And we may have to pay $2,000 to sell it. Fair value minus cost to sell is 70,000. Right? Fair value minus cost to sell is 70. On the other hand, what is value in use? Value in use is, let's say if the asset has 5 years life and all the future cash flows in year 1, 2, 3, 4, 5, if they are discounted into the present value, unlike in the previous US GAAP model, where we just simply added up, all the future undiscounted cash flows. Here we will discount them. We will bring these future cash flows into their present term, and this number is $80,000. This is what you call the value in use. So what is value in use? It is the present value of the future cash flows. Whatever we will receive from this asset in the future, including its disposal value, discounting all of them to its present value is called what's the value in use. So whichever of these number is higher, of course 80 is higher, you take 80 as a recoverable amount, and now you compare the recoverable amount with the carrying value. Clearly the 20,000 loss can be recognized. That's the step. Please keep that in mind. We will revisit, read the theory and do the questions to further hammer in the concept in your memory. So let's redo it now. How do we do impairment under the IFRS? It's now in the written in text. Reporting date assessment indicates there is a possible loss. Impairment loss is the difference between carrying amount, which is $100,000, and recoverable amount, which we just determined to be 80. Now, what is recoverable amount? Recoverable amount, it is the greater number between fair value minus cost to sell, which we determined to be 72 is the fair value, 2,000 was the cost to sell, it was 70,000. And value in use, this is the present value of the future cash flows, that is 80. So you take this number, which is higher of these two, and you compare this with the carrying amount, and the difference between these will be the impairment loss. Right? So I hope you got the idea. Some important points here to be noted, specifically related to IFRS. Impairment loss under the IFRS may be reversed in a subsequent period if a change has occurred and you can now bring the asset back to its original value. Any reversal cannot be charged against the balance sheet. It has to be reported as a gain in your continuing operations income statement. In other words, reversal of impairment loss, it is recognized immediately in profit or loss as a part of your income from continuing operations. So this is quite a contrast to what we've done in the US GAAP. In the US GAAP, impairment loss cannot be reversed subsequently, but under the IFRS, the impairment loss, if the asset increases its value, we can reverse this loss and show it as an income from continuing operation, right? So that was the difference. Let us do some questions to enhance our understanding. Under IFRS, an asset is impaired when its carrying amount exceeds its recoverable amount. Now, what is recoverable amount? Recoverable amount, simply deduct, cut lower. There's not lower. There is no such word as lower. Greater of its fair value plus cost to sell minus value in use. Greater of fair value plus cost to sell. This is what makes this statement wrong. There is fair value and cost to sell, but it's fair value minus cost to sell. Correct. Fair value minus cost to sell. This is the first element which we determined to be 70,000 in our example. And value in use, this is the present value future cash flows. Greater of these is what you take as a comparator, and you compare it with the carrying amount, the difference between carrying amount, and this will be considered as your impairment loss. Correct, Ibrar, you're right. So that makes D to be the correct option. Next, which of the following statement is true regarding the long-lived assets impairment? US GAAP requires one-step impairment. Wrong. It requires two-step impairment. This is incorrect. Read no further. Both IFRS and US GAAP permits reversal of impairment loss. This is incorrect as well. IFRS allows reversal, GAAP doesn't. Both IFRS and US GAAP prohibit reversal. This is again incorrect. What is true? Under the US GAAP, reversal of impairment loss is in subsequent period is prohibited. Basically, this line continues this way, but not in IFRS. US GAAP doesn't allow reversal, IFRS does. And that's what we have just read a little while ago. So that makes D to be the correct option. Okay, now let's do some computational question here. An entity applies IFRS on December 31st, year 1. It estimates the following information regarding its headquarter building. we have the fair value, cost to sell, value in use, residual value, and NRV. Okay, we will take only what is required. According to information above, forget about what is needed. Let us do what we do. We take carrying value at one end, which appears to be given here. Is it fair value, cost to sell, value in use? Mafi, there is no carrying value given. So what we can only do is establish recoverable amount. Now, what is recoverable amount? It is higher of these two. Which two? Value in use, fair value minus cost to sell. Cost to sell. Just take these and compare which of these is higher. That will be called as the recoverable amount. Recoverable amount. So value in use is given straightforward. It's 90. Fair value is given as $100,000, and the cost to sell is 15. 100,000 less 15 is going to be 85,000. Now 85,000 versus 90, the bigger is 90,000. This 90,000 will be compared with carrying value. If carrying value is more, let's say, again, Ross is little uncomfortable with this number, but this is what we are doing in every example. Let's say carrying value is $100,000, and if the recoverable amount is 90, so there's going to be $10,000 loss. But if, let's say, the carrying value is 70, let's say, then clearly recoverable amount is more, the amount is more, so there's going to be no impairment. So right here, we just needed the recoverable amount, so that gives you 90,000 as your answer. All right, so this was the gap. US gap was discussed earlier. This was the IFRS impairment of your long-lived asset, property, plant, and equipment, and those assets which are intangible but which have definite life or finite life. Now, the last area of today's lecture involves disposal of long-lived assets. We sell assets during its life when we no longer need them. So when we sell these assets, either there's a gain or loss. How do we record this gain and loss? Through journal entries, and how it is calculated? It's fairly straightforward, but let's just do it. A company sold a machine with a carrying amount of $100,000. What is carrying amount? Again, cost 100,000. This number appears to be my favorite as well as the writer's favorite. 100,000 is the carrying value. 180 is the historical cost, and 80,000 is the accumulated depreciation. The difference between these is carrying value or book value. And it was sold for 135,000 cash. The gain on disposal is recognized this way. Let us do it in two ways. First is the simple common sense that carrying value is $100,000, and the disposal value when at the price at which you sell is $135,000. Clearly, carrying value was 100. It was disposed at 35,000. This clearly 35,000 is gain. This is the common sense. We can do it. But sometimes we have to bring it into the recording, so into your accounting system. You will enter it in your journal. The entry you will make, debit cash, 135,000, that's what you're receiving. Since the asset is being disposed, you have to remove the accumulated depreciation from your books of account. You will debit the accumulated depreciation because accumulated depreciation has a credit balance. To remove, you have to debit it. You have to remove the cost of the asset from the books, so you need to credit it. If you look at the debit side is stronger, bigger. Credit side is shorter. 135 plus 80 less 180. Credit side is short by 35. So clearly, when the credit side is short, it is gain. $35,000 is the gain on disposal, to be reported as part of your continuing income statement or income from continuing operation. Now let's twist things around. Instead of 135, what if the machine was sold for $90,000? Then what? We'll do the same common sense approach. Our carrying value was $100,000 and the disposal value is 90. So clearly there is a $10,000 loss. That's the loss on disposal. We can also do it using journal entry. What we do, we receive 90,000 cash, debit. Accumulated depreciation must be removed from the books. Accumulated depreciation, debit. Machine must be removed from the book at its full cost, machine credit. Now the difference comes on the debit side of the entry, which clearly is 10, which was the loss. So you write as loss on disposal. So you need to know what the entries are, and you need to know how to calculate the gain and loss on disposal. So let's do a few questions and apply this concept there. An entity purchased a machine on January 1st, year one for $1 million. That's the original historical cost. We have a question. 1 million is the cost of the asset. The machine had an estimated useful life of 9 years and a residual value of $100,000. The entity uses straight line depreciation, which means if we calculate the depreciation, it's going to be 1 million less $100,000. This will give us the depreciable base, and it is to be depreciated over 9 years. So it means every year the depreciation is going to be $100,000 per annum. Fine. The entity uses straight line depreciation on December 31st, year 4, exactly after 4 years. The machine was sold for $535. So there are two approaches of doing it. One is you compare the carrying value with the disposal value. Carrying value was 1 million, the original cost, and the depreciation charge so far, year 1, full, 2, 3, 4. 4-year depreciation will be $400,000. Right? Which means your carrying value is going to be $600,000. Now, you compare this carrying value with the disposal value. Disposal value is $535. You can compare now. Carrying value was $600,000. Disposal value is $535. So this is $65,000. This is clearly loss on disposal. Loss on disposal. 600,000 versus 535. So that's the loss on disposal. That makes B to be the correct option. Now, if you do it using the journal entry concept, it will still give you the same answer. What you will do, you will debit cash. You are receiving cash, so you're going to debit cash 535. You're going to debit the accumulated depreciation charge so far, that was $400,000. You're going to credit the cost of the machine, which was 1 million. Right? Now, if you just see, the debit is credit is 1 million, debit is just 535 plus 400. It is 935. It is short by $65,000. So clearly it's on debit, so it's loss on disposal. So in both ways, you get the same number, that is B. Let's try another one. Let us try another one. It says an entity purchased a machine for $700,000. The machine was depreciated using the straight line method and had a residual value 40. The machine was sold on December 31st, year 1. The accumulated depreciation was 494, 495. The entity reported a gain on the sale of transaction of 75 in its income statement. We need to find the selling price. So he can give us anything and required to find out any unknown number. So let us do in our conventional approach, common sense. We acquired a machine for $700,000. So let's first find the carrying value. This is the original cost. Now, when are we selling this machine? We are selling this machine in December 31st, year 1, after first year only. After first year only, which means the depreciation is going to be we don't need to calculate depreciation. It is already given. 495 is the depreciation charge so far. No need to calculate. So carrying value is the original historical cost minus the accumulated depreciation. So it's going to be 205. That's the carrying value. Now, since there is a gain of $75,000, the book value was 205. That surely means we would have sold at 75,000 up, means we would have sold at 280,000. There is a gain of 75,000. Since there is a gain, carrying value is 205. We sold at 75,000 gain, which means we would have sold at 280. This is the disposal value, and that's what we were required to find out. Selling price was to be calculated. Now, let's say if you find this little twisted, we can just do it using the accounting entry. We can simply debit cash what we receive, or you can simply debit the accumulated depreciation first, what is given. Accumulated depreciation is going to be debited with 495. You're going to credit the machine cost, which is already given as $700,000. There is clearly a gain given. You credit the gain, that is 75. Now, if you total the debit and credit, you will find that your debit side is short by 495, less 700, less 75. It is short by 280, and this 280 is clearly the cash received, the cash collected against the disposal. So 280 makes option A to be the correct option. So either you use your conventional common sense or you simply use the journal entry approach, you will get right. So cash is 280 and there is a gain of $75,000. Yes, since depreciation amount is given, so we won't take the residual value. That was what I thought why you have to do. But since the depreciation amount is given accumulated, we can straight go to the computation and find the gain and loss. All right, next question. An entity sold a depreciable asset in the middle of fifth year, which means 4 years are over and we have just a part of the fifth year, which means 4.5 years. That's an important piece of information. An entity sold a depreciated asset in the middle of the fifth year after 4.5 from its purchase. This asset had a life of 10 years. The original cost of the asset was $100,000 and it was being depreciated on the straight line basis. If the asset was sold for 80, what is the gain? Let's do first the conventional approach. First, we'll find the carrying value. It is equal to the original historical cost minus accumulated depreciation. Now, this asset was acquired for $100,000. It is not going to have any scrap value or residual value. Just divide it by 10. That means the annual depreciation is $10,000. If there are 4.5 years, your accumulated depreciation for 4.5 years will be $45,000, which means your carrying value is $55,000, right? Now, if carrying value is 55, disposal value is 80, clearly there is a gain. There is a gain of difference between these two is 25. So that makes B to be the correct option. Correct. Now, let's say if we do it using the journal entry, what we do, we take cash, which is 80,000 debit. We need to remove the accumulated depreciation of 45 from our books. Accumulated depreciation is debited with $45,000. Asset must be removed from the books, whatever it was, machine or asset. Remove the original cost, and you will find that the difference is on the credit side. So this 25,000 on the credit side will surely be the gain on disposal. So either way, you get 25,000 as your answer. And guys, that was the last question, and this completes your property, plant and equipment impairment, as well as the impairment on assets with definite life.